Welcome back to the morning show here on Arise News. That the Nigerian economy is in a tailspin is not in doubt. Portfolio investors are fleeing the equities and fixed income markets. Share prices are taking a bashing, while yields on bonds are hitting the roof, signposting a decline in confidence in the Nigerian economy. This has not been helped by President Muhammadu Buhari's recent directive to the Central Bank of Nigeria, asking it to ban importers of food from accessing foreign exchange in the official share market. Add to this the 9 billion judgment debt given against Nigeria by a British commercial court over a dispute between the federal government and Process and Industrial Development Limited, as well as a query issued to the chairman of the Federal Inland Revenue Service. It is obvious that the ominous clouds seem again to be gathering over the country. Here to discuss this and a lot more is Bismarck Rewane, Chief Executive of Financial Derivatives Limited. Mr. Rewane, welcome to the morning show.
Welcome.
Good morning.
Well, you know, just as I said in the introduction, the Nigerian economy is in a tailspin. You know, the stock market, stocks are hitting very low levels. There is, you know, a lack of optimism about the future. Only yesterday, the Vice President of Nigeria himself was saying Nigeria faces what looks like a fiscal crisis. Now, what is responsible for this? Is it pessimism on the part of investors, or failure of policy, or lack of understanding in terms of how, you know, the macroeconomic indicators should be tweaked?
First and foremost, I will not go as far as to say that the Nigerian economy is in a tailspin. I think that the Nigerian economy is stalled. In other words, it's growing suboptimally. It could do better. But I think that there is a fundamental problem of understanding or defining what the economic strategy is. Basically, my understanding of the misunderstanding is this, that the presidential team are of the view that government spending and government investment are enough to actually push this economy forward. Two, that a private sector partnership, junior partnership of the private sector with the government will do, and that with these two, they will cross the finish line. But the reality, and the way I see it, and the facts, you know, empirical evidence shows this, that the Nigerian government's policy of economic patriotism, dogmatic holding on to protectionism, is not a valid strategy at this point in time. In other words, the Nigerian government and the Nigerian people, not just the government, people have to accept that the mixed economic model is what is required. The mixed economic model says that private sector investment and gross fixed capital multiplied by, you know, basically, which produces a positive investment multiplier, will create income growth, income on one hand, growth on the other, and jobs to be supported by government spending and government investment. All of this together, basically fiscal stimulus. What you've been hearing lately are monetary policy measures to solve fiscal problems. It's not a bad idea, but unfortunately, it is not effective and it doesn't work. You can get a pediatrician in an emergency to do the job of a surgeon, to do the job of a cardiologist. But that's not it. His calling is to treat children. And even you can have a pediatric cardiologist and all that, but if your area of specialization is not what is required, you can only use those people in the interim to stabilize the situation and then get it on. So, using monetary policy measures, using restrictions on foreign exchange, which will only distort the allocation of resources and force investors into having higher level of uncertainty will be a problem. So I think that context has to be understood.
Well, in other words, if I get you right, you are not quite pleased with the decision recently by the president to direct the CBN to restrict access to importers of food in the forex official market. But there have been other issues that people have raised. The president, for example, says that this has become necessary in order to encourage agriculture in Nigeria and that we have reached a level of full food security.
You see, people use defined concepts that may suit them. The reality is that if you look at materiality, how much imported food is, how much of Nigeria imports is food? And when you talk about food, are you talking about finished food or food inputs? For example, wheat. You bring wheat here and you mill it, and then it becomes flour. Are you banning or are you restricting the importation of wheat? Are you restricting the importation of brown free-flowing sugar, which is then processed to becoming white sugar? Are you restricting the import of ingredients into making Cerelac, morning, Milo, Bonvita? Is that your definition? You see, the thing about investment wants two clear things. One, it wants certainty and clarity. And two, it needs people who are willing to respect the sanctity of contracts. Whenever you have a conversation with investors and they respond to one action by asking that potent question, what next? 3 weeks ago, we talked about dairy products being identified as an area. And dairy products means milk and all of these things. And all, powdered milk, cheese. Okay. And everybody said, okay, dairy products, the total bill is $1.2 billion, which, by the way, may not be totally accurate. Now, and everybody sat back and said, okay. The investors I spoke with said, after dairy products, what next? Then 2 weeks later, there's a blanket conversation around food. Finished food, processed food, food input. So the question was, is this what was next? And after food, what next?
CBN governor says there will be more.
Yes, so you have increased the uncertainty. And investors do not like uncertainty.
Which is why, as well, FDI in Nigeria, the highest FDI we had in years came in 2007, and we haven't seen anything like that since then. We're still now struggling to even just make the top 10 in Africa, and it's a serious problem. But you brought up the issue of the sanctity of contracts, which is a topical issue right now, given the case with PNID and the ruling judgment that was given towards them. And it's a very embarrassing situation for Nigeria for a number of reasons. Now, if we have to pay this money, we're going to lose 20% of our external reserves. And that is such a dire position to be in. What is your take on this situation with PNID that's come out this week?
No, I think it's, first and foremost, the seed capital or the question, the issue in controversy was nowhere near $9 billion, nowhere near even $500 million. Yeah. So the question is, what happened? And at what point of negligence did this pothole become a trench? At what point?
That's the best way to put it.
At what point, who are the people responsible who could have taken actions to ensure that we don't get here? I have no doubt in my mind that the higher courts in Britain will give a ruling which is much more friendly than what you have now. Because what you have now, there's no way for every little thing, then you come and attach $9 billion. I think it sounds quite absurd. But we are in a world of laws. And if you slip on your rights, there's a price to be paid. So the question we should be asking, one...
Equity is the vigilant, not the indolent.
Let's defend our position. Or we should ask the question, under whose watch did this thing deteriorate to a point where it has become a problem? It has become a problem. And have we learned any lessons? How many more problems are in the woodwork that will come up and then, you see, people say, what you see is what you get. Well, the dangerous thing is what you don't see is what gets you.
Food for thought. On that note, we'll go on a very short break, and as soon as we're back, the conversation continues. Don't go anywhere.
Welcome back to the morning show here on Arise News. Still with us in the studio is Bismarck Rewane, the CEO of Financial Derivatives. Now, before we took that break, we were discussing the PNID case in London. And incidentally, I have before me here a report saying that the EFCC is going to probe the PNID. And the story is quoting the governor of the central bank, Reuben and Laila. Is there a role for the EFCC in this particular matter?
I'm not a lawyer, I don't know, but on the face of it, the activities of a company in Nigeria can be probed by the EFCC whether there are any financial crimes. But this is a judgment in the United Kingdom. Obviously, from what I hear, there was arbitration and people slept on their rights. They didn't do what they have to do. And then the matter was referred to a court because you find that in every contract they will say this contract is either governed by the laws of this. So for the court in the United Kingdom to rule, they must, first of all, have established jurisdiction, establish that there was violation of rights or people seeking remedies. And in their judgment, maybe general or specific damages have been awarded. But if you say that something that started as a $6 million transaction ends up as a $9 billion liability, it sounds a bit bizarre to me. So
there was interest of 7% per annum.
Yeah,
that was how they got to the 9.6.
I know, and a point came when they said every day you didn't do something, there was a fine of 1 million, some ridiculous penalty clauses. But all of those things will be put to test. But even without saying anything, the fact that you have a claim of $9 billion against you, and the international lawyers are going to charge a particular fee. Let us say, for the sake of argument, it's 1%. Talk about that. First of all, you're going to be paying lawyers about 90 to God knows, maybe 100 or something million dollars for what you needn't have had to pay in the first place. And you are going to have to ask yourself, how did this happen? How did the $6 million transaction end up as a $9 billion liability? No. So, and how many more of these things are going to pop up? Because you know what happens that vultures come. Once they see there's one vulnerability, then other things are going to happen. And these are the things that make investors wary. How do you know what's going to happen? But
so maybe the role of the EFCC may be to go after persons who have brought this embarrassment to Nigeria, causing this threat of financial loss.
Maybe. Or also look at those who negligently allowed it to metamorphose into what you have, right? Or a combination of all. But also to create an environment here where people don't go into contracts, designed, maybe willfully for that matter, to default, and so that they can share in whatever spoils will come from the matter overseas. But here is a case where I think there's a Nigerian government guarantee. So the EFCC has a right, actually, to take a deeper look at what happened.
Really and truly, because there's this serious bleeding going all through the system. Earlier on this year, I recall an article by Forbes that was titled, Nigeria, Africa's Money-Losing Machine. And reading down that article, we were compared to a country like Venezuela. And one of my greatest worries, and I think a worry for a lot of citizens when they heard about this Forex ban on food imports, was the fact that it's just going to become a smuggler's paradise. And that's only going to lead to hyperinflation. And maybe then what was said in Forbes about Nigeria being compared to Venezuela actually becomes very, very relevant. So what situation are we really diving into here? Because it seems as though we're not even taking it as seriously as we should.
No, I think that protectionism on its own is a sign that you want to live within your means, right? However, when there's a conflict between your tactical moves, because that's a tactical move. If you do this, then your reserves will be preserved and all of that. And your long-term goal, the ultimate goal of every economist and every public office holder is for the economy to grow at a rate that is higher than that of population, higher than that of unemployment, and possibly, if you could, higher than the rate of inflation, if you could. Now, what we are growing at is at about 2%, 2.1%. We'll be lucky to do that. Now, by taking these measures and investors become weary, you are losing that which you need, which is the investment, core investment, as a base to drive economic growth. And the thing about investment is that, and like Reuben pointed out, investors are worried. If they are worried, it's not, they don't stay at where they are. They don't stay at zero. They take money out. And once investment starts moving negatively, it is compounded by what we call a multiplier. If it comes positively, then you have a positive investment multiplier. In other words, if I invest $100 million, K being the multiplier, will be used to compound the $100 million, and then income will grow at about maybe $200 to $300 million. If investment goes from 300 to 200, which means it has lost 100 million, the K becomes a negative multiplier. So instead of having GDP of 300, or that is 300 minus 200 minus 100, having 200, you would have a GDP of 100, because the 100 that has gone, compounded by the multiplier, negative multiplier, will reduce income. So you can't say to hell with these investors. You can't say that, because the investors are the ones that bring in the income and have the multiplier effect. The multiplier effect is what creates jobs. So one, you have an economy that is strong. Two, you have an economy that is growing. And three, you have jobs being created.
We're talking about investors
Yes.
and measures. Reuters reported yesterday that the Governor of Central Bank of Nigeria has been meeting or trying to reach out to bond managers in the United Kingdom to see how he can lure back investors to address the liquidity crisis that we have in Nigeria, particularly in the event of oil prices falling and the Naira weakening. What exactly, are you optimistic about that move? Do you think that these investors would, return on the basis of assurances?
No,
like
I don't. Firstly, I don't think the foreign portfolio investors that the central bank is talking to have gone.
Okay.
The maturities that are going to come up in September and October. So he's making a preemptive move. Please don't take your money when it matures, right? But they are not here because of the words of anybody. They are here because the yields on their instruments and the guaranteed exit rate gives them what they call a carry trade, which is in their own best interest. But if a country relies more on hedge fund and what we call hot money, those monies are not loyal to anybody. They will go at one point in time. So what we need to do is to look for a much more fundamental and shift towards the foreign direct investment, concessionary borrowing when we can, and investments that are here in pursuing opportunities that are here, not portfolio investors that bring in the money because of a rate of interest and a carry trade. So I think that is true. The central bank is right to go out there, because if oil prices were to tumble, and they are likely, in fact, it went all the way from 70 down to 55, and now it's back up to 59. If they were to tumble and production was to drop or shift, because right now our production is coming more from the deep water, which is revenue insensitive. In other words, Nigeria will not get that much revenue from those offshore because those guys have to recover their money. We are staring at what we may call a gap. And that gap has to be filled. But that gap is not immediate, right? We have to be strategic about it. And the gap will be filled, one, by increased government revenue if we can. Two, by foreign direct investment, where Nestle, Shell, Guinness, Nigerian breweries, Cadbury are bringing money in to buy plant and equipment to expand operations and employ people. If those guys are sitting on the fence and asking that question, which I started of this program by saying, what next? Then they will not bring their money in. And you'll be left in the hands of the vultures, which we call hedge funds, who are loyal to nobody but their pockets, and naturally that's why they're hedge funds. Then we become vulnerable. I think that Nigeria is at crossroads. I think that we don't have a liquidity crisis. I don't think that investors are running away in droves. They are leaving, but they are measured, right? So what should the government do today? I mean, we know the problems are very well documented and defined. First thing is that the government has to agree and accept that a profitable organization is not inimical to Nigeria. And investors are here to make a profit. They need to be incentivized. Investors do not care what you say, but they mind what you do.
And as a portfolio investor, let's look at our bond market, for example. It's so weak and lucrative. How do you think this affects investors' decisions?
Well, the bond market is a market that is driven by yields. What's the shape of your yield curve? Are the yields higher than the rate of inflation? Luckily, in the last 2 months, third month coming, inflation has declined. Headline inflation has declined. However, I don't think anybody should be fooled by that. One, the moment we started reversing and changing the interest rate environment to lower coupon rates, because we want to reduce our debt service. One. Two, the minimum wage has only been paid for grade 1 to 4, grade 4 to 17, and all other consequential costs are quite significant. The federal government has offered 10,000 naira per individual, irrespective of if you earn more than 30,000 before. The unions are saying they want a percentage. Once you go for the percentage return, you will bankrupt the institution. But even if they accept in September, for every month, this thing is effective April, May, June, July, August, 50,000 naira per employee in arrears, multiplied by something like 1.9 million. I'm assuming that the grade 1 to 4 are about 200,000. So about 2 million employees in the federal government alone. Please don't forget the state workers. State workers are about 1.9 million. When you multiply this, the impact of that check that is going to be written, right?
Flabbergasting.
It is going to be it's be a challenge. So, in other words, the inflation trend that you are seeing today may not be sustainable because of two things. One, your minimum wage payment, which is fiscal, which you have to pay. And secondly, this low interest rate environment that is being created, and at the same time, this restriction on forex activities, which will reduce foreign direct investment, could become a contradiction.
Mr. Rewane, just before we go, we have less than 2 minutes for this segment. I'd like to ask you, by tomorrow, a new Minister of Finance is likely to be announced. What kind of priorities or expectations do you have for whoever is the Minister of Finance? But we have just very little time.
About 10 seconds.
Okay. The fiscal team, I don't want to say the Minister of Finance.
Okay.
There's the Minister of Industry, Trade and Investment.
Yes.
There's the Budget and Planning. There's the Finance Ministry and a couple of other things. Once the fiscal team is in place and the economic management team, by implication, draws its powers from there, then you will see monetary and fiscal coordination. Depending on the characters, the strength of character of the
coordination. Good coordination on the fiscal side with the monetary side.
Yeah.
Thank you very much.
Thank you very much.
Mr. Rewane.